Hello, my name is Nate Crosby. This is your market update for May 21st. My eyes this week were on Home Depot. Why Home Depot? Well, it reported earnings on Tuesday before the market opening. And if I look at the previous weeks, the previous month, what you would see if you were following the market is a lot of the traditional tech names like Apple and Microsoft, which have been high flyers up from March of last year to roughly present. They've had trouble gaining their footing. So a lot of the buzz was, are we seeing a rotation out of tech and into something else? So my eyes were on Home Depot because I consider Home Depot to be more of a value play. It's a value company on steroids. It has a nice growth rate, but it also has that nice dividend to go along with it, which makes it, in my mind, a great value company. It's been a staple in our foundation of our equity portfolios for a very, very long time. What was expected of a Home Depot was a net earnings increase of 25% or better. Now that's a very high bar to clear, even for what I believe is America's best run retailer. What did they report? They reported net sales increase of 32.7%. So they blew it out of the ballpark. What did the shares do? After the market opening, the shares began to fall. And my colleague, Derek, who helps me manage the portfolios, one of the things he said was, I don't think we have a technology problem. I think that we may have a valuation problem. So what he meant by that is these stocks that are trading at a little bit higher multiples, that have been the high flyers for the past 12 months, even though they are still reporting fantastic quarters, the market itself is having a little bit of a hard time sending them even further. Instead, we're seeing it favor more value companies that have a little bit lower multiples. So what have we done to our models to prepare for this? We've always had value as part of the stock portion of our models. We've increased that a little bit. So namely through VIG, the Vanguard Dividend Appreciation ETF. We love that ETF, and that's a great place to find value stocks. Dividend payers. We have tilted the portfolios, as I mentioned in the past video, to favor financials. We are continuing to do that. I think financials have an easier road ahead of them than many of the other sectors in the market. We are also tilting the portfolio to favor energy. I mentioned in the previous video, we have added the commodities index. If I look at inflation year over year as of April, the CPI is at 4.2%. That is not seasonally adjusted, so stop a moment and think about that. Year over year, the basket of goods that they measure for the consumer price index has increased by 4.2%. So if I've got money stashed away in a savings account that's earning 0.01%, I'm in trouble with that money. More than ever, if it's money that I do not need for emergency, or if it's money that is not going to pay my mortgage, I want that in assets that has the ability to outpace inflation over time. Our fixed income portion continues to be favoring short duration, and along with commodities, we always add a little bit of gold in there as well. I consider gold a commodity, but in most of our models, we will separate the gold from the commodities index as well. So that's the game plan. If you look at that, we've got different asset classes. Our moderate high model by asset volume continues to be probably our most popular model. Well, it is our most popular model. And in that model, you've got stocks of all shapes and sizes, favoring the value dividend currently, favoring the financials, favoring the energy. We've got fixed income, we've got commodities, we've got gold, and real estate. Real estate also has the ability to benefit from inflation. So stay the course, be well diversified, and after that, continue to buy high quality companies. I'm Nate Crosby again. Thanks for listening. Enjoy the weekend.